Imagine this. You've implemented and mastered the 50-30-20 rule. Your cash flow is stable, your expenses are controlled, and for the first time, you're actually ready to invest. Now a new question appears. How do you allocate your assets properly? How much stays in cash? How much goes into index funds? And how do you decide without guessing? Because here's the part most people miss. Your long-term investment success has almost nothing to do with picking the right stock, not the perfect ETF, not the next hot real estate market, not even timing the recession. The real driver of results happens before any of that. Decades of institutional research suggest something far less exciting and far more powerful. Your results are driven primarily by how you allocate your assets, not what you pick. And here's the uncomfortable truth. If your portfolio doesn't have defined roles, it doesn't have a strategy, it has bets. Today, we're going to fix that. We'll break down how to master asset allocation across three foundational pillars: cash, index funds, real estate. Grounded in Federal Reserve data, Vanguard research, SPIVA performance reports, and modern portfolio theory. No opinion, just structure. Asset allocation is not about predicting markets. In the landmark Brinson, Hood, and Bauer study, researchers found that asset allocation explained the majority of long-term portfolio variability, far more than stock picking or market timing. That insight reshaped institutional investing. Here's the key idea. A healthy portfolio is built from complementary roles, not competing bets. Think of your portfolio like architecture. Cash is the foundation. Index funds are the structure. Real estate is an income-producing extension. Each asset has a job. When assets compete, portfolios break. When assets complement, portfolios endure. Let's begin with cash. Cash is not a growth engine. It is a shock absorber. According to Federal Reserve household finance data, families with adequate liquid savings are significantly more resilient to income shocks and unexpected expenses. Vanguard recommends maintaining 3 to 6 months of essential expenses in liquid reserves. Now let's make this real. Imagine your $300,000 portfolio drops 30%. It falls to $210,000. At the same time, you lose your job. If you don't have cash, you're forced to sell investments at the bottom. That damage compounds. Now imagine you have 6 months of expenses in cash. You don't sell, you wait, you recover. Cash buys time, and in investing, time is everything. But here's the tension. Cash loses purchasing power to inflation. That's why it's capped, not maximized. Typical guidelines: stable income, 3 to 4 months of expenses. Variable income, 6 to 12 months. Real estate investor, emergency fund plus property reserves. Cash keeps you invested. That's its job.
Now, index funds. If cash protects you, index funds grow you. They provide broad diversification, low cost, and market-level returns. SPIVA scorecards consistently show that most active managers underperform their benchmarks over long periods, especially after fees. Vanguard research highlights cost control and discipline as key predictors of investor success. Let's look at the math. $100,000 invested at 8% annually for 30 years grows to roughly $1 million. Reduce that return to 6%. Now it becomes about $574,000. That 2% difference costs over $400,000. Costs compound in reverse. That's why index funds are typically the core of a portfolio. Early or mid-career investors often allocate 60 to 80% of long-term capital to stock index funds. Approaching retirement, volatility is reduced gradually, not by abandoning growth, but by balancing exposure. Index funds grow the portfolio if you can stay invested.
And staying invested depends on having sufficient cash. Notice the system forming. Now let's talk about real estate. Real estate behaves less like a stock and more like a small business. According to Federal Reserve data, real estate represents a major component of household net worth in the United States. It offers rental income, potential inflation sensitivity, leverage, and tax advantages. But here's the reality. Real estate is concentrated. One property, one location, one tenant at a time. Let's examine leverage. Purchase a $400,000 property with $80,000 down. If the property appreciates 5%, that's a $20,000 gain. On $80,000 invested, that's a 25% return before expenses. Leverage magnifies gains. It also magnifies losses. Real estate introduces maintenance risk, vacancy risk, interest rate exposure, and illiquidity. Typical allocations range from 10 to 30% of total net worth for active investors. Passive exposure through REITs may be smaller. Real estate should complement index funds, not replace them. Now, step back. Modern portfolio theory shows that combining assets with different risk characteristics improves risk-adjusted outcomes. Let's simplify. Cash protects against forced selling. Index funds protect against purchasing power erosion. Real estate protects against income instability. Each asset has a weakness. Cash loses to inflation. Index funds fluctuate. Real estate is illiquid and leveraged. Together, they offset one another. This is not prediction, it's engineering. So, how do you apply this? Step 1. Secure cash first. Size it to your income stability. Step 2. Build the index core, low-cost, diversified, automated. Step 3. Add real estate deliberately, only when cash flow and reserves are solid. Step 4. Rebalance periodically. Behavioral finance research consistently shows that underperformance is driven more by emotional timing errors than asset selection. Rebalancing removes emotion. It forces discipline. It institutionalizes good behavior. Let's anchor this. Cash keeps you invested. Index funds grow your capital. Real estate adds income, if managed deliberately. 3 roles, 1 system. Wealth is rarely built through brilliance. It is built through structure. When your assets have defined roles, your decisions become clearer. You stop reacting. You start allocating. And over decades, that discipline compounds. Mastering allocation isn't about beating the market. It's about building something that survives it.